Today we're going to talk about debt and the wealth transfer that is created by certain types of debt. Generally speaking, most people would say that debt on a home or debt for a real estate investment or a business loan that creates income is actually a positive debt. The other type of debt is consumer debt, debt that is on your car payments, your credit cards, maybe even student loans. It's debt that is on depreciating assets, assets that do not create income. So for example, a car payment. Every time you make a car payment, that money leaves your checking account and it never returns. Now you've got the car and you're driving it, but at the end of the day, that car is worth a lot less than what you paid for it. So there is an actual wealth transfer. And we're going to focus today on what happens when we pay for a car. So in our example today, we're going to talk about having a car payment of $400 a month over a 72-month or 6-year period of time. If we total up all the payments, it comes to $28,800 in total payments. So generally speaking, that is dollars that have left your account and they do not come back. But there's another thing that we have to take into consideration, and that is the fact that had we not purchased that car, we would have been able to take that $400 and save or invest it somewhere. So just for fun, we're going to plug in a 6% interest rate, and we're not going to worry about taxes right now. That 6% over 72 months would have generated $34,736 if we'd have had it in a savings account. So a wealth transfer is not only the actual dollars that we sent away, but it's the interest or the earnings that we could have had on those dollars over that period of time. So in this particular case, we're looking at somewhere in the neighborhood of about $6,000 in interest earnings that we have given up. That is called lost opportunity cost. It's the opportunity to have earned interest on something that you no longer have those dollars. Now, if you had not purchased the car and you had been saving those dollars, and another 10 years had gone by. In other words, the $34,736 that was your original lost opportunity cost, at the same 6% over 10 years, it's now up to $62,207. So what we want you to see is that all lost opportunity costs, all wealth transfers are eternal, meaning you can never recapture those dollars because they never come back to you. And this is just an illustration of what it would be like in 10 years. What if we looked at 20 years? It's $111,000. That one vehicle transferred wealth away from you of $111,403. And let me put that into perspective. That is the money that the financial institution earned on the dollars that you gave them. You gave them $400 a month for 72 months. They could earn 6% on it. And then once you got done paying off the car, they were able to continue to use the money, use the capital. They reinvested it over 10 years, 20 years. It's $111,000. What if over 30 years? So the amounts are staggering. Now that's just one car. What if you bought 6 or 7 cars over your lifetime? Okay. Well, here's that same $400 for a period of say 20 years. Over 20 years, you have car payments. Every month, you've got a $400 a month car payment. Look at what that transfers out of your checking account, $185,740. That's an astonishing number. Now, if we add a lost opportunity cost to that figure, meaning $185,740, just over 10 years from the time that you got done paying for your vehicles, 10 years later, that lost opportunity cost is $332,632. In 20 years, it's nearly $600,000. Here's the point we're trying to make. Lost opportunity costs can never be recaptured. As a result, we have to identify them before they happen and find ways to reduce or eliminate the wealth transfer. One of the things that we teach our clients is how to identify the wealth transfers in their life and to reduce them, mitigate them, and in some cases we can actually recapture the wealth transfers in your life so that you are no longer having that wealth transferred away from you.